We're going to look at a question on foreign currency translation. In any foreign currency translation question, it's very important that right at the beginning for you to determine whether you're doing a local to functional currency translation or functional to presentation currency translation. And how can we tell one from the other? So first of all, you can see that in this question, you got a US dollar here. So that means that you got subsidiary that is located in the US. So the local currency is US dollar. Then if you take a look at the additional information, you can see that for additional information E, the functional currency of Wilson Limited is also US dollars. If the local is US dollar, the functional currency is also US dollar, you are definitely not doing local to functional currency translation. What you can see here is that we got a requirement. They want you to prepare the translation into Australian dollars. So the Australian dollars is going to be the presentation currency. So if the functional currency is US dollar and then presentation currency is Australian dollar, this is the translation that we are going to do. And this is the most important decision that you have to make at the beginning of this question. The other thing you need to be aware of is that when you do the conversion of exchange rates, you need to know whether you are multiplying the exchange rate or divide the exchange rate. And what do we need to do here? You can see that we need to exchange US dollar to Australian dollar. Then you take a look at the table of all the currency rates here. You can see that we have 1 US dollar equals to whatever Australian dollar is in the same direction. As a result, when we do the conversion, we need to multiply the rate, not divide. Okay? Not divide. So that will be the second decision you need to make. After that, we can then move on to the actual statement. So in the next 2 pages, you can see that we got the income statement as well as the balance sheet. Then you've got to think about this. We are now doing functional to presentation currency translation. Where do we actually put the translation difference? Either it's going to be a reserve or it's going to be a gain or loss. Because for this one, we are doing functional to presentation currency translation, the translation difference is going to be FCTR. This FCTR is going to be on the balance sheet. It's a reserve, foreign currency translation reserve. Given that the translation difference is going to be on the balance sheet, we are going to begin with the income statement. So we're going to start with the income statement first. That will be the first one that we do. So what we can see is that we have the original record from the subsidiary with all the US dollar there. What we want to do is to translate into Australian dollar by following a number of rules. Let's go back to the original question. Additional information A, it says that all revenue and expenses occur evenly throughout the period, which means that we are going to use the average rate for most of the revenue and expenses. Because they say that with the exception of closing inventory, which was purchased during June 2015. When they got a specific time period or specific date for a particular transaction, you have to make sure that you use a specific exchange rate. For example, if they say that the closing inventory were purchased during June 2015, you can see that we got an average of June 2015. That is a specific rate that we are going to use for closing inventory. Also, we got an interest that was paid on 30th of June 2015. Also, you can see that we got a rate for 3rd of June 2015 as well. After that, we also got a loan interest. We also got dividend. Dividend, they say that they paid that on 31st of March 2015. Once again, we got a specific rate for March 2015. And then we also got equipment as well, which we'll talk about that a little bit later. Let's write down the easy one first. So starting from the top, sales. Sales, according to the question, they incur that evenly throughout the year. So as a result, we are going to use the average for the whole year. Average for the whole year is 1.14. What I normally prefer to do is to write down all the rates before we do the translation right at the end. After that, we got the opening inventory. Opening inventory, this is the first year that you acquire the particular company. So as a result, the opening inventory comes from the acquisition date. So right here, acquisition date is 1.20. Okay, that's July 2014. So we're going to use 1.20. Purchases incurred evenly throughout the year, so 1.14. Then closing inventory, the question already told you that they purchased that during June 2015. So the average for that month is 1.15. The cost of goods sold will be the subtotal, which we'll calculate that later, same as the gross profit. I'm going to skip depreciation for the time being because that one is a little bit more complicated. I want to spend more time to explain that. After that, we also got interest, which according to the question, they paid that on 3rd of June 2015, which have a rate of 1.16. That's the rate on that particular date. Other expenses, just like the purchases, they incurred that evenly throughout the year. So it's going to be 1.14. If we go down further, we got income tax expense as well. Also, it's going to be based on average. There are two more items that we need to put on the rate. The first one is the opening retained earning. Just like opening inventory, because you carry forward from last year, which is the pre-acquisition rate. So that one is 1.20. And finally, with the dividend paid, let's go back to the question. It says that the dividend pay, it was 31st of March 2015, and the rate is going to be 1.12. So pretty much the idea of the income statement is that whenever that you incur that particular revenue and expenses, that is the rates that you are going to apply. So the one that I'm missing there is depreciation. If you recall the rules of depreciation that apply to functional to presentation translation, you will know that we are going to use average. It should be the average rate, which according to this question, the average rate is 1.14. So we should just put 1.14 here. The problem is that with depreciation, it applies to plant and equipment. It's very important for you to look at whether they have purchased any new equipment in the current year before you write down any exchange rate. Based on this question, additional information D, the only movement in plant and equipment during the year related to an item of equipment which was acquired on 30th of September 2014 for 20,000. All the depreciation is based on 10%. It's not the depreciation rate that matters here. It's going to be the time. Because as you can see that this is 30th of September 2014. This is 9 months before the financial year end. 9 months before the June 2015. Why is that important? Because depreciation, yes, we are using the average rate. But right now for this new piece of equipment, we are only going to use the average rate from the dates that you bought it to the date of the balance date. And right now you can see that we got the average from October to June for 1.13, which is different from the average for the whole year. As a result, we need to distinguish the amount of depreciation applied to the new equipment that you purchase as well as the equipment that you already have on your record. And how can we tell the difference? Right here, we have $20,000. Okay, $20,000. We are going to actually go to the balance sheet and take a look at the plants there. You can see that we have 160,000. 160,000. 20,000 is new. That means the old one is 140,000. Why is this piece of information important? Let's go back to our income statement. Right now, we have 15,500. 15,500, which you know that 140,000 is the old equipment. 20,000 is the new equipment. 140,000 multiplied by 10%, that's equals to 14,000. Which means that out of the 15,500, $14,000 you are going to apply the rate of 1.14 because this one is for the whole year. On the other hand, we also got the new equipment. The new equipment, $20,000 is the new one. If you apply a 10% of depreciation rate, you are going to get $2,000 per annum. But remember, we only got 9 months from the dates that you purchase until the balance date. So 9 months of depreciation is going to give you $1,500. And this is how you actually get $15,500. Because you got the $14,000 from the old equipment and you also got $1,500 for the new equipment. Then now let's write down the rates. So the rates there, if you multiply by 1.14, that will be the rate that you apply for that $14,000. If you got 1,500, if you multiply by 1.13, that will be the depreciation rates that you apply for the new equipment. So the total is the combination of the two. So it's very important for you to distinguish them. So I believe we have all the rates that we need now. Then what you do next is very simple. You just multiply the rates with the original US dollar, then you can find the Australian dollar equivalent. So starting from the top, you got the US dollar of 370,000. You multiply by 1.14, you're going to get 421,800. Do the same thing for opening inventory, purchases, and then closing inventory. Very importantly, when it is in bracket, also keep that in bracket. Then you know that you are doing deduction. So right there, cost of goods sold, if you got the opening inventory plus the purchase minus closing inventory, that's equals to the cost of goods sold. So you are going to get 252,000. Finally, if you got sales, that minus the cost of goods sold, you're going to get the gross profit of 169,800. Then with the depreciation, as you can see that we got two different amounts. We got 15960 for the old equipment, and then we got 1,695. In total, you are going to get 17,655. After that, we got the interest, other expenses, and then we can continue to calculate your profit before tax. So if you got a gross profit minus all other expenses, depreciation, interest, and other expenses, you are going to get a profit before tax of 124,125. And then you translate the income tax expense, which is $39,900. And then profit before tax minus income tax expense, you're going to get profit after tax, 84,225. Then you continue to translate the opening retained earning. Dividend pay, once again, is in bracket. Finally, profit after tax plus opening retained earning minus dividend pay, that's going to give you closing retained earning. That will be the end of this income statement. As I mentioned earlier, the reason that you want to attempt the income statement first, that is because there's no missing figure on this statement. So as a result, you can complete the entire statement before you move on to the balance sheet. With functional to presentation currency translation, the balance sheet is very, very straightforward. Because if you recall from the rules, pretty much every single assets and liabilities, it doesn't matter when they buy it or whether they acquired it from someone else, doesn't really matter. There's no monetary or non-monetary distinction. Everything is going to be based on the current rate, current closing rate. Let's go back to the question. You can see that the current closing rate is on 3rd of June 2015, which is 1.16. So go to write that for every single one. Even though you can see that we got the new equipment and the old equipment, doesn't matter. They're going to be based on the same rate. Every single one is going to be based on the same rate. So if we move on with capital, capital comes from pre-acquisition. So you are going to use the pre-acquisition rate. Pre-acquisition rate is going to be 1.20. That's all the rates that we can apply. So what do we do here is to translate that one by one. So what you can see here is that we got 150,800 for cash. Then we also do the translation for all the other amounts as well. So it's a very straightforward translation. So with total asset, pretty much what you do is to add up all the asset and then minus the accumulated depreciation. You're going to get 458,200. After that, trade payable. So once again, if you add up the total liabilities is going to be 162,400. Then the net asset, as we all know that net asset equals to total asset minus total liabilities. So the net asset for this one is 295,800. Then we move on to translate the capital. The capital is 144,000. And then you can see that you're stuck now because we can't translate the retained earnings because the retained earnings come from different sources. Also, we can't really balance the account at the moment. Okay? But what you can see is that the retained earnings actually come from the income statement. Why do I say that? Because when you go back to the income statement, you can see that we got 157,825. You already calculated your closing retained earnings. Right now, you can copy it across to your balance sheet. Okay. But then if you add up the capital and the retained earnings, it doesn't actually equals to your net asset at the moment. In fact, when you got the net asset of 295,800, you're going to copy that at the end as well because you all know that net assets must equals to equity by default. So we're going to write down 295,800. But it doesn't balance the balance sheet at the moment. The reason is because we got the translation difference that we want to recognize. So you can see that there's a blank there. You need to write down foreign currency translation reserve. So what you are going to do is to add up the capital and retained earnings, and then you want to compare to your total equity. You will see that the FCTR will become a negative 6,025. And you must put that in bracket because foreign currency translation reserve, it can be a positive number or a negative number. In this case, you got a negative reserve and you must put that in bracket. So after you do that, you will be able to see that you are able to balance the balance sheet. So you add up the capital, retained earnings, and also the FCTR, they should be equal to the total equity.